What if selling your business didn't have to feel like giving away your life's work? What if you could walk away with not just more money, but more peace of mind, more control, and more confidence in what comes next? Welcome back to the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today I'm joined by a guest who has helped countless entrepreneurs do exactly that, John Martinka. He's an experienced exit planning advisor and the author of Exit with Style and Grace and More Money. In this episode, we dig into what it really takes to prepare your business for a successful exit. We talk about the hidden value killers that most business owners overlook, how to make yourself replaceable without sacrificing leadership, and why your financials might be quietly sabotaging your sale. John also shares how to structure your team, your incentives, and your strategy in a way that attracts the right buyers. So you don't just sell your business, you protect what you've built. This conversation is packed with practical advice and powerful perspective. So if your goal is to grow, protect, and one day exit your business with confidence and clarity, this episode is for you and you don't want to miss it. And if you're ready to start building a proactive tax strategy that aligns with your long-term exit plan, head over to vitalstrategies.com/tax. That's where you'll find the tools and resources to help you keep more of what you earned and take intentional steps towards your future. Let's dive into this conversation. Thank you, everybody, for joining us here today. I'm excited about our conversation with John Martinka. We are going to get into a discussion about really what it looks like to position your business to sell. And John has literally written the book, Exit with Style and Grace and More Money. So we're really going to spend some time looking at what it takes to take a profitable, successful business and sell it. So John, thank you so much for joining us here.
I'm glad to be here.
So when I think about what an entrepreneur is going through, running a business is hard. They've got blood, sweat, and tears invested in this thing. And then these questions start coming up like, man, at some point I'd like to exit this. Most of my net worth is held in this business. What does it take to do that? Am I positioned to do that? And then, philosophically, it seems like it just doesn't seem fair that the process can feel hard. And so I'm excited to have you join us here today and really just bring some clarity to what it looks like to exit our business at the end of our career, or maybe even in the middle if we're looking to make a change and do something else. So thank you. If it's okay, can you tell us a little bit of your background, how you got involved in the exit planning and succession space?
Well, I got into it through serendipity. How's that?
Yeah.
I was in a small Rotary Club here where I am in Kirkland, Washington, and had joined at the manager I had at the time in a completely different industry, and my veterinarian both were saying, you ought to join a Rotary Club and give back to the community. And I did. Mm-hmm. And this is, I think, an interesting sidelight story. I'm a new member, I'm a young guy, and they said, we're doing an auction with another Rotary Club and everyone has to go out and get at least $1,000 of donations. And I went out and got $1,000 or more of donations. And all the, we'll just call them the more senior members were sitting on their hands and not getting them. And they said, wait a minute, this guy's pretty good. And I got, right away, I'm on the board, and then I'm in the queue to be president. And the guy I was president after, we hit it off. Our wives got along, and one day he said something like, I've always thought you'd be good in this business. And it was good timing. He knew it was good timing. He knew I liked but didn't love what I was doing. And, when you're working with people, what I do, whether it's entering entrepreneurship through buying a business, or as a friend called it, re-entrepreneurs, when they're purchasing, or exiting, it's usually going to be the biggest financial decision of their life.
Yeah.
And it carries a lot of risk going in, and it carries risk going out to make sure you do it right. We hear a lot about maximum value, but more important than that is making sure you sell to the right buyer. So, and I talking to someone recently, and he says, well, my financial advisor says, just take whoever offers the most money, take it. Just take the money. And I said, yeah, that may not work so well if that person's not qualified, and the employees bail, and the customers don't like him, and then all of a sudden he's going to blame you, and you're going to be in a lawsuit.
Right. Yep. Yeah. No, this is great. So we're starting to wander into what it it takes to really successfully sell our business. And so, one of the things we're looking at, I think about when I'm buying or selling things, there's generally three numbers that I'm interested in. What is my price? That's awfully important, like you just mentioned. But what's my monthly payment? What are the terms of those payments? Like, those things can all start to factor in. And if it's, SBA financing or seller financing or some of those other factors, like those, I think all play in. So as we get into this discussion, I also want to highlight, who I think we're looking at here. And I think this is really our key audience as well. This is not the Main Street business. This is not the mom and pop coffee shop that's, maybe doing $1 million of revenue. It's also not a large established business that's going to be selling to private equity or some other strategic buyers. This is the mature, well-organized business that's been profitable and doing well. Would you like to define that, sort of who you consider your ideal listener for the things we're going to be talking about?
Yeah, you hit a couple good points there. Our market is, broadly defined as the lower middle market, which means a lot of different things to different people. We work at companies that we target with a value of around $4 or $5 million up to 15 to maybe 20. We don't want to play in the same space as the Main Street broker, the delis, the dry cleaners, the little business where if the owner's not there to, make a delivery, some days there's, people don't get what they ordered. And on the other end, we stay away from what the true investment bankers do, because they're more qualified to do those private equity deals. And speaking of private equity, though, I have come to realize over the last, handful of years, there are many different stratas of private equity. From the true private equity firm that's raised a fund and says, we don't want anything that's less than 5 million of EBITDA, unless we're going to bolt it on to something we already have and it's an easy fit. You have, 3 million threshold, 2 million threshold. You have people calling themselves micro private equity that don't have a fund, but they've got money from certain investors, friends, family, whatever. And it's legitimate money, but it's not tied to a fund. So they can be more like a family office and buy and hold.
Mm-hmm. Yeah. Yeah. I love this. So thank you for clarifying exactly, who we're talking to here. And I think this is good. I'd love to talk more about, I really appreciate the thinking around selling the business with all of those things that are in the title of your book: exit with style, grace, and more money. That sounds ideal to me. Can we lay the foundation for how we start to do that?
Yeah, and it's a topic that can be touchy to a lot of owners. And I will tell you that everyone I talk to that does business improvement consulting and coaching will usually say what I'm going to lead off with, and that is the toughest job is getting the owner out of the day-to-day. We call it owner dependency. There is just the thought that it's my business. I started it, or I got it and scaled it, and I'm the one who knows how to do all this stuff. And I like doing it, but it doesn't increase value. What increases value is when you have a team that you delegate to, and they do what they're supposed to do, and you can concentrate as an owner on where are we going next? Are we making an acquisition? Are we going to go for more product lines or service lines? Are we going to put in a new marketing plan that has a lot of promise and expand it into a wider area? All those vision type of things.
Yeah. I love that. So let's pretend for a second that I'm interested in selling my business. Yeah. We've identified that I need to be easily replaceable, right? If my job is vision, great. That's good. Then the next buyer can come with vision and go. If I'm responsible for producing the product or service, that's problematic. So what do we look at next? What is the sort of the next piece of the discussion that if I'm really looking to position my business well, that I should have in place?
Is it what everyone thinks it is truly, or is your accounting department like Cinderella, the weak little stepsister off in the corner, and you don't know what's on those statements is accurate or not?
Yeah.
I was asked one about a year and a half ago. I said, how confident are you in your financial statements? And I get this blustery 100%. Then why are there balance sheet items on the income statement?
Mm-hmm.
Another one I saw recently is, a company had like $1.5 million of inventory. Every year it was the same amount down to the penny. They are not doing inventory. They don't know what they have, how good it is, or are they expensing inventory, which, actually is showing income less than what it really should be. So get your financial systems solid, in order, have the right people doing them. Don't call your bookkeeper and accountant and that kind of thing.
Right.
And then you'll have accurate statements.
Yeah. I think that's a fantastic point of view. And it's something that we've spent a lot of time talking about on the podcast. We talk to our clients about if our financials are a mess, if we can't look at those clearly, it just reduces your value on the sale dramatically, because there's now unknowns taking place inside of that business that the buyer's like, I'm taking on a risk acquiring this thing, and I'm going to just start discounting as much as I can when I'm uncertain. And on the opposite side, I see if I'm a buyer, I don't necessarily get too spun up about messy financials, because I'm just going to start applying discounts everywhere. It's going to be bad for the person selling that business, but maybe good for me as the buyer, especially if I see top line and I'm like, okay, I know if we've got those revenues, we can apply our systems and processes and create some efficiencies in here that are going to turn out. But interesting enough, I had a conversation with a client this morning that, to your point on the financials, right? And you have to have the right finance team in place, right? Whether that's staff accountants or fractional CFOs or controllers, like you need those people in place to make sure that your books are good. And, I would say engaging with somebody like you a few years ahead of when you actually want to sell, to have you look at things and go, hey, you've got some enormous gaps in this process. We need to go clean those up. And then we'll be in a good position to sell is a critical piece. But going back to my client I was talking to today, at the sale, the seller had no idea what the working capital requirements were and what kind of check he was going to have to write. He thought it was going to be a $50,000, $60,000 check. It was an $800,000 check he had to write for the working capital. And it's like, if you don't have a finance team around you that can help crystallize those figures, he had, I don't know, I'll call it his brother's cousin, doing the accounting for him, and it was a mess. So I think those things it's an ounce of prevention on the front end is worth a pound of cure on the back end. Just making sure that you do the books well all along the way.
Yeah, you're right, and brings up a couple quick things, and that is, I know someone who sold the business, and his representative wasn't on top of it, and the lawyer was young and inexperienced, and the working capital became a real mess. It wasn't defined right. No one really understood it on either side. And it is a big point of contention on that, and I've seen where sellers will start accelerating receivables and only to come out and find out, well, wait a minute, that fits into the working capital formula and target, and I'm going to have to give that money back. But I want to bring up one other point. It's the short-sightedness of many owners who say, I'm going to blend my personal and business checkbook. I'm going to write off personal expenses to pay less taxes. And I call it short-sighted because I've got a little document on my computer, and the bottom line is, let's say, I don't care what you're making, $500,000, $1 million, whatever. And you say, well, I'm going to write off $100,000 of personal expenses, my second home mortgage payment, the groceries, the gas, the insurance, everything for the family, blah, 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 blah.
Yeah.
And you look at it and you say, okay, I wrote off 100,000. I saved, what's the top federal tax, assuming no state
37.
tax,
Yeah.
but federal tax, 37%. I saved $37,000. If I'm selling my business for a multiple of 5, that $100,000 is 500,000. It takes a lot of years of that to catch up. So if someone says, I want to sell in 3 years, it'd be point that out and start paying your personal expenses from your personal accounts, show higher profit. You'll get less discussion on the statements. The banks or investors won't be questioning, was it really a personal expense or not?
Yeah. Yeah. No, I love that. And we're just firm believers of, we feel like there's enough opportunity on the tax strategy side of things to do legitimate deductions versus just shove all this, personal crap in your books. And I guess I do have a question there. When it gets to the point of looking at some add backs and that type of thing, is there some best practices because, there might be things like a vehicle, my cell phones, some of these things that like line up as legitimate business expenses that I can take that are also personal expenses that the new owner's not going to have to account for, or am I just sort of out of luck? I'm losing out on a multiple of that revenue because I left those things.
No, I mean, that's a legitimate, I don't, it's moved, let me back up here. It's moved from the time when, the owner had a cell phone, and now I see a lot of small businesses where the key employees have a company paid cell phone. I mean, we're talking peanuts there.
Right.
The vehicle, if it's really used in the business, but it's all it's the travel and the other things that, really aren't a business expense. Again, it's short-sightedness because that multiple is going to come back. And the buyer, any buyer is going to do the same thing. If it's an individual, they're going to write off their cell phone and they're going to write off their medical insurance and all of that. And if it's a professional buyer like private equity, they're going to have I'm sure they're going to pay for the cell phone for the CEO. And
yeah. Okay. Yeah, no, that's great. And again, last point on the finance side, but is there, are you seeing firms do quality of earnings reports for either on when I'm getting ready to sell, I'm doing my QOE, quality of earnings, having a firm do that to just say, hey, these numbers are good, they are legit, and we can explain them to a potential buyer. Are you seeing that happen pretty regularly, or is that an uncommon practice?
In my market, I don't see it happen regularly. If I'm at the upper end, I would definitely encourage them to have at least a quality of earnings light, not the full-blown 50, 75 or whatever thousands of dollars on a full one. Buyers at that level, buyers probably going to do their own anyway. And it's like business valuations. A bank will not accept a business valuation the seller pays for. So if the bank will look at it, but they can say, well, the seller paid for this. Yes, there's an arm's length transaction, but if it's a large enough deal, they want to see what the buyer comes up with from their accountants.
Right. Yep. I think about if I go to my bank with an appraisal that I did on my property to have it refinanced or something, they're going to be like, that's cute, but we're going to pay for our own and make sure that it's.
No, they're going to have you pay for the one they do.
Yes. Thank you. That's a great point. Very good. All right, John. So now that we've thinking through the steps here, we figured out how to remove the business owner. We've got our financials cleaned up. What are next steps in this process?
Okay, here's a couple things. Grow. Show you can grow. I mean, if you look at ads for businesses for sale, you see on almost all of them the word potential. Show you can grow. And I understand there are a lot of owners out there, been at it for a while. Let's just say I'm making $1 million a year in profit. I got a salary on top of that. And I'm really have a nice life. Why would I want to grow? Because you'll get more in the end. It ties into another key factor, and that is be able to attract and retain really good to great people. And those
Yeah.
people are looking to have career advancement.
Mhm.
And if you're coasting, well, first of all, you can only coast downhill.
Yep.
But if you're coasting, they might get fed up and go somewhere else, or
Yep.
they're not going to give it their all. And show you can grow. Don't just say, "Hey, we could do things and we could grow." Uh,
Yep. Yeah.
so that's I think that's a big one. That I don't care if it's in my market. Again, we're not talking a dry cleaner, but
Yep.
from the individual buyer who's come out of the corporate world and they've managed people and processes, money,
Mhm.
and I like to add enthusiasm, up to the professional buyers of family office, PE, etc. They're all looking to grow. Grow and scale are two words they like to use.
Yeah. I love it. And one of the things that we've seen when I think private equity is easiest to use as an example because they're so well organized and capitalized. The first thing they spend money on is sales and marketing. They're like, we are going to dial this thing up and see what we can do here to just continue to drive revenue into the business. It's revenue makes the business happen. Now we need to run that business efficiently and effectively to get, I'll say, good EBITDA so we can get a good multiple. But at the end of the day, it starts with dollars coming in and making sure that that's happening. And I assume when you're talking about growth, we're talking about organic growth, right? Like I've seen some businesses pick up some small mom and pops, that have helped top line and they create some efficiencies. But yeah, can you talk just a little bit more about like the type of growth that buyers like to see?
We're talking organic growth.
Yeah.
It depends on the industry too. There are some where you have to grow by acquisition. It could be geographic. Depends on the kind of service that there are limits to where you can go and service clients without having another location. But organic growth is what buyers want to see. They can add growth by acquisition. They can do bolt-ons.
Yeah. Yep. Great. Good. And then I think you talked about another key piece, and this relates back to your first point, but being able to attract great people, right? If I can build a team around me that can help run the business well, now I can start focusing on maybe what we'll call my unique ability to run the business effectively, cast vision, and drive this thing forward. And that all ties well with growth. Is there anything else to talk about with attracting great people when it comes to looking to sell?
They want responsibility. And I mean, just think back in your career, and people you worked with, and I go back a long ways, and I had lunch with a lady I was working with, and she says, I need she's telling me I need to go to the owner of the company and get a raise. And she said, I've been here, for this long a time, and I really need a raise. And I said, well, why do you deserve a raise? Well, I've been here a long time. I said, no, you got to lay out, what are you doing now that you weren't doing when you were hired? And it was quite a bit. I mean, she'd taken on a lot of roles and responsibilities. And, one of your other podcasts I was listening to was a gentleman talking about sales and solving a problem. That's what we do. We solve a problem. Problem is my business isn't ready to sell. Well, let's get it ready to sell, or let's find a great buyer. And in her case, the problem was she was thinking small. And she got the raise because she pointed out all the things she was doing to add value to the company.
Yeah. I think about, we'll call them A players in our organization, right? They are worth almost whatever salary we could possibly pay them because they're worth a multiple of value, right? If I'm paying them $100,000, they might be worth $200,000, $300,000, $500,000 to the bottom line. And it's like, I'll take as many of those folks as we can. It's the person that you were talking about that the concept of like, hey, I've been here a while, like pay me more money. It's like, no. This is a value equation. And if you're delivering value, I'm happy to pay you for that.
Yeah.
So,
well, let me add to that, because whether it's the luck of the draw or whatever, but I think at least 3, if not the last 4 deals where we've helped clients sell the business, they have taken some of their money and put it into retention bonuses
Mm.
for their key people.
Yeah.
And it's not like, sign an employment agreement and get a bonus. No, you're going to get it at the end of a year. In one case, it was staggered 1, 2, and 3 years. Formulas based on seniority and job responsibility, salary, and all that. But helping the buyer out, and as one owner said, these are the people that built my business to get me where I am.
Mm-hmm. Yeah, I love it. So the next thing I think about when I'm thinking about people is the people generally need some systems and processes to run on when it comes to running an effective business. How are you seeing in the transaction side of things, like how important is that, we'll call them standard operating procedures or workflows or what have you. How important is that in the process?
They haven't put in those policies and procedures on how everything is done. And as you know, we talk about retaining good people. There are all kinds of statistics on different job levels and what it costs to hire and train someone to replace someone. And if you have those systems and processes, I'm sure that cuts, I don't know what it cuts it down, but let's say if it cuts it, the cost of adding a person, not just replacing, but just adding new people, cuts that ramp up time in half.
Right.
Yeah.
Yeah, it's so true. And we just see that organizationally for us, we're doing all the things you're talking about. We're growing, we're adding new people, we're trying to be a culture that is a fantastic place to work. And it's just so interesting as our firm has developed, just building more of those systems and processes, how it's so much easier for the next advisor that joins the team to be able to get up to speed, because it's not me having to download it from my brain into theirs. They have a track to run on. So great. Very good. Hey, real quick, before we get back to the conversation, if you're a business owner thinking about how to pay less in taxes, keep more of what you earn, and ultimately position your business for a strong exit someday, then you've got to check out vitalstrategies.com/tax. We've put together a free resource to help you start building out a proactive tax strategy, one that goes beyond just write-offs and starts positioning you for long-term savings and real wealth creation. Whether you're preparing to sell your business in a few years or just want to tighten things up today, this is where it starts. So head over to vitalstrategies.com/tax. Grab the free tools and start unlocking the tax strategies that high-level entrepreneurs use to stay lean and build big. All right, let's get back to the episode. So, I mean, we've made a lot of progress here, right? We've removed the odor. We've got our finances in place. We've got great people. We've talked about systems and processes. If I'm looking to sell, what else should be a part of this discussion that I need to get organized?
Here are 3 quick things, and I'm going to preface it with the statement: a business seller controls the deal when it's a good business, and that's what we're aiming for. The buyer controls it if your business isn't that good. So we've hit some of the big ones. I would say then reduce any other dependencies. Get your customer concentration in order. I mean, yes, small businesses are going to have a dominant customer, but a dominant customer at 18% is a lot better than at 60%, or top 3 customers at 80% of sales. Same with suppliers, and even with a key employee. That you get that one person that if they leave, boy, are we in trouble. They're the only one who can do this kind of bid or this kind of service or whatever it is. And these days, as you know, I call it the 3 I's. The first one is IP. If you've got IP, protect it and do what it takes. Trademark, patent, copyrights, IT. When's the last time you picked up any kind of business or maybe even non-business publication and didn't see something on hacking and phishing and all that stuff? And it's real. And it's dangerous.
Absolutely. And I'd like to just highlight for a second that they're not just going after these huge firms. They are picking on the small guys too. And, data breaches, ransomware, all of those things, they can bring your business to your knees if you're not protected. So
and they're going after individuals too. We have a
Mhm.
friend and she fell for it. She got an email. She thought it was from an old friend who said something about, I can't get this to go through. Can you get a $300 DoorDash gift card? And
Mhm.
is, and as soon as her husband found out, he said, but it was too late. She got scammed.
Yep. Yep.
And then the other third eye is incentives.
Mm.
I talked about the incentive on a retention bonus. I'm going to talk about a friend who has bought many companies, 7 or 8 by now. And on his second one, he went in and we noticed that I was working for him on the acquisition side. We noticed the inside salespeople were really poorly paid.
Hmm.
And the owner was, after every last dime. And he went in and put in an incentive plan, raised their comp, put in bonuses, uh, and it worked. He grew the company
Mhm.
75% his first year.
Yeah. Yeah. That's incredible. And I am curious because we've seen some clients with the understanding of like their aim has been to sell the business, and so they've created some incentive programs for their key people that are tied to the business valuation. And it's so interesting to see how invested everybody is in that growth. And so, do you see those as um, worthwhile? Because I feel like their execution is actually pretty challenging to do well and to do right. But do you see those plans helping drive the business value when everybody's sort of rowing in the same direction?
Well, you're not going to incentivize every employee,
Hmm.
probably. And then you have an ESOP, and those can be the best thing around, or the biggest mess around. But
Hmm.
our last deal, client closed the deal. He had 2 key employees, his 2 senior managers, COO, and um, I don't know what the other one was, but it was a C level, and
Hmm.
they had phantom shares, and it was in writing. Uh, it This brings up an interesting point. It was in writing. In the tax returns, there were K1s for these 2 guys showing zero share of profit.
Hmm.
But what does that mean? It means that when the company sold, they got their phantom shares and paid capital gains tax. If it was just a letter that said, "Hey, when we sell, you have phantom shares of 100 shares," and
Yeah.
it turns out, let's say it's worth $100,000. If they're not, it's not done properly, and they're not getting a K1 showing, zero income, that's
Yeah.
ordinary income tax.
Yeah. Yeah. And we've seen that. And I love what you're talking about there. And I think there's probably a whole legal discussion that could be had on entity structure and how to properly put those in place. So, they still get that K1 without the profit distribution, but when they recognize the sale, they get capital gains treatment, because capital gains treatment versus income tax treatment you could be paying twice as much
Yeah,
tax in that
easily.
scenario. So yeah, yeah, that's a fantastic point. Wonderful. Okay, John, this is all fantastic. Is there anything else that we should be talking about if I'm positioning my business? I love all the I's, the IP, the IT, and incentives. Like those are all great. What else do we have? That we need to be talking about.
We talked a little bit about, how buyers, they want to see a company where they can come in and work on strategy, not on
Hmm.
programming the machine. So it's see the big picture.
Hmm.
Uh, I've someone he was a president of one of the divisions at Expedia, and his comment to me was, growth hides a lot of operational warts, and then you can go back and fix the warts.
Hmm.
So
Yep.
see the big picture. I mean, uh, have a vision and go after it.
Yeah. Yeah, and I love that. And I'm going to give you an example of see the big picture. Um, we've got a client who their business is named something that doesn't even apply to what they're currently uh, like doing. It's very like niche specific name, and they're still growing it. I don't know, 25% a year. And the owner's like, people give me a hard time about the name of our business. But guess what? We show up and provide tremendous value to our clients. We have a great sales team. I do not want to get distracted by rebranding and all these other things. We will fix that at some point in the future, or the future buyer could take care of that issue. But like we are working on up and to the right, and it's working. It's like I am not going to be distracted by these little things. And he was telling me a story about a friend of his that was rebranding, and he was like, "What is your sales?" And he was like, "I don't know why you're wasting your time on that." So I love that distinction. That's great.
Two quick stories about myths on Business Buy Sell. Myth number one is, why don't you just hire a general manager and then keep all the profits? And I say, well, there's still risk. You're still the owner's still the one on the line. If the general manager or anything screws up, you're going to get sued, not the general manager. But it's a story. Every year we go down through my Rotary Club to Antigua in the Caribbean, and we spend a couple of weeks and we work in the schools. And it's great work. Well, we were there this past February, and we found this pretty new Italian restaurant in the Caribbean. The owner is from Rome, and she owns the building that has like 36 boutique hotel rooms and a fantastic Italian restaurant. And we were talking to her, and she had done some remodeling, and she said, "Yeah, I was back in Italy, and I had a general manager, and it just went downhill, and it went downhill fast because they didn't really care."
Yep.
And that, you can't do that. The other thing is, sellers have, I talked before about sellers have to get the right buyer. And there's a story in my first book called Buying a Business That Makes You Rich about a guy who was an accountant, and he just thought it would be great to own a business that made something. And he bought a cabinet shop. And the short version of the story is he came to hate not only the business, but he hated the business because of the employees. And he couldn't understand why these, I guess mostly guys, cared more about their next cigarette break, getting a beer after work, or going fishing on the weekend versus growing his business. And he just had a culture problem that was driving the business down.
Yeah. That's
so there has to be a fit, not necessarily direct industry experience, but the guy who shows up in a suit to a cabinet making shop is not going to relate to the employees if he's not smart enough to realize I better put on my jeans and a sweatshirt.
Yep. And back to your first point on hire a general manager. I've got a close friend that has built a successful business. He hired, I'll call it a full executive team, and they promptly ran the business straight into the ground. He was took his eye off the ball, not paying attention to what was happening. I'll say his finance guy was incompetent, maybe even leaning towards the fraud side of the equation with the things that were going on. And it's like, I think as an owner, if you're going to be an owner, the buck stops with you. You've got to be at least at a high level, paying attention to the financials, asking smart questions, making sure that you've got a dashboard that's giving you a healthy understanding of where the business is at, where the issues are and what is not going well. Because otherwise you can end up, thinking you're in one position with a very successful business, and then you're almost on the brink of bankruptcy with this thing, falling apart on you, and it's almost too late to get it together. Yeah. So I love that. People think, oh, business is easy. I'm just going to hire somebody and put them in and run this thing. And business is not easy. It's hard. It takes time, energy, blood, sweat, and tears. So
these operating businesses, I say they need the adult supervision only an owner can provide.
Yeah,
this is not a popcorn shop in the wall.
Yep, absolutely. John, this has been fantastic. When I think about these things. Building a successful business, engaging with somebody like you to help me make sure that, I've got all my I's dotted and T's crossed when it comes time to sell, I think is a critical piece. And then ultimately having somebody, we believe in who, not how, right? Like, let's get a who in my life that can help me run these things versus me trying to understand how to do it. And so you've been there, you've done that when it comes to the business exit process. And so I think, again, I love the title of your book. I think that's fantastic when we start thinking about exiting with style, with grace, and more money. Like, that is what we all ultimately want when that process comes to a completion. And so that sounds like a successful result to me. I think we think about the other end of that equation. We don't engage with a professional that has the experience in the background. The process is hard. We don't have our business positioned appropriately. We don't get what we want. There could be, lawsuits and all these other things that can come with not doing it well. So I think that is all fantastic. Now, I think you've got a couple things for us. I love the fact that you've got a book out there. And so people will have a link to that in the show notes. They can go download that book from Amazon. I think that's fantastic. But I also think you've got a form on your website. If people want more information, you're happy to get them to them. And then also have a free link to the book if that's if they mention the podcast in there. So we'll have a link to that as well. But anything else to add to best ways for people to get in touch with you?
Yeah, it's actually not a link, but if they mention the podcast, if you fill out the contact form, we'll send you a free e-copy of the book.
All right. Wonderful. Well, what we can do is we can just make sure that link is in the show notes so it's easy for people to find. The website, it's martinkaconsulting.com. And so we'll again have links to that so people can find your website and check out all the good resources you have on your web page. It's fantastic. It's all sorts of blog posts and good media. So we appreciate that. John, this has been fantastic. I think this is a critical conversation for any business owner that is looking to grow and scale and at some point recognize the value of their business. It's where most of our entrepreneur clients are holding the majority of their net worth. It's in their business. And so you don't want that transaction to go sideways. So I appreciate the expertise that you bring to the marketplace.
Yeah, thank you. And I enjoyed being here. It's a good conversation.
Thanks so much for tuning into this episode of the Vital Wealth Strategies podcast. I hope you found real value in today's conversation with John Martinka, and that it gave you a fresh perspective on how to prepare your business for a successful and profitable exit. If you've got something out of this episode, I'd love for you to share it with a fellow entrepreneur, someone who's building something meaningful and needs to hear this. And be sure to come back next week. We've got another powerful episode lined up that will help you minimize your taxes, grow your wealth, and optimize your business and your life. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. You're vital to me because you're committed to growing your wealth, leading with purpose, and building something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives. And if you're ready to take action now, go to vitalstrategies.com/tax, start building out your strategy, and unlock smarter ways to grow and protect what you've worked so hard to build. Take care, and we'll see you next time.